Hi, everybody, and let's take a look at what's happening with the S&P 500 index. We're looking at it from last year, 5,963, going all the way to 7,005 or 400 and 500, as you can see, making new highs. But what are these new highs really based on? Let's take a look. So the S&P 500 is index that's composed of 500 stocks. Of those 52-week highs, mostly as you can see, these are tech stocks. 33 were making new highs. But if you look underneath the hood of that S&P 500 index, you can see about 45 of them are making 52-week lows. And the majority of them, as you can see, are composed of NVIDIA, Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, mostly tech stocks, which make a good percentage weight of the S&P 500. So if you think you're getting diversified with buying the S&P 500 index, making new highs, but unfortunately those highs are weighted and skewed toward the top 10 stocks, which make almost about 38% of the stock, and one stock gives 6%. So as you can see, the combined 100 stocks give only 2.3% of the weight of the S&P 500 index. So we're getting a picture of, yes, making new highs, but underneath it, the majority of the stocks are making new lows. So I would recommend that at this point, if you have the S&P 500 index, it's best to just sell it because as you can see, uh, the entire index is really composed of the top 7 to 10 stocks, which make 31% of the index, and the bottom 100 stocks make only 2%. So if you think you're getting, a diversification and you're getting a stock index, ETF index that's going to continue going up, I think it's going to lead to a lot of disappointments because just now 2% of these tech companies control 38.5% of the index. So at this moment, I think the best thing is to sell the S&P 500 index if you have it, because it's skewed towards high tech, high EI stocks, which if it goes down, that index will come down. All right, everybody, have a great weekend. We'll touch base again. Have a great day. Bye bye.